Welcome back to Taxes Made Simple. My name is Carlton Dennis. In today's video, we'll be going over stock taxes for 2021. Now, maybe you were someone who decided to get into the stock market last year in 2020 during an epidemic when everything was shutting down and we were trying to figure out where we were going to get our toilet paper from. Or maybe you were someone who decided to get into the stock market this year as things are starting to recover here in 2021. Either way, is if you're investing your money, you are going to need to know the tax consequences whenever you decide to sell your stocks. So in today's video, we're going to go over what the taxes are associated with stock sales in 2021 and what you can do in 2021 to avoid the taxes associated with your stock sales. And if you stay till the end of this video, I'll go over 2 strategies that will help position you to avoid the taxes associated with your stock sales in 2021. Let's begin. Now, in order for us to go over the taxes associated with stocks, we first have to understand what is basis. This is probably one of the biggest terms that comes up when we as tax strategists are explaining to investors what capital gains tax is. Because in order for us as tax providers to calculate capital gains tax, we have to understand what the basis is on the stocks that you sold, which means that the companies that you're using to host your investments on have to be tracking your basis and tracking your gains for us, your tax providers, to know how much tax you're actually going to pay. So the first thing that we have to understand is what is basis. Basis is a number that is provided to you when you decide to purchase a stock. It is given to you. It's a number that we utilize to track your gain because any income that is earned in excess of the basis is considered a capital gain. And any losses that you experience that fall from the basis number are considered capital losses that you get to claim on your tax return. So basis is the most important number for us to know as tax providers. But as a taxpayer, you need to know what type of taxes that you're going to be subject to. So what we're going to do is we're going to jump into the iPad and we're going to go over a long-term capital gains tax first. But you should know that long-term capital gains revolves around 3 percentages. There's a 0%, a 15%, and a 20%, which happens to be the maximum percentage when you decide to hold on to your stocks for longer than 365 days. That's right, guys. The magic number is 365. And if you're patient enough, the government is going to give you these reduced tax rates. So what we're going to do is we're going to talk about the IRS's definition of long-term capital gains. They state that the tax rate on most net capital gains is no higher than 15% for most individuals. However, some or all net capital gains may be taxed at 0 if your taxable income is less than $80,000. What this means is if I don't have any other income and I just decide to do stocks, and I pull out $70,999, I'm still not going to pay taxes on that amount of money.
You serious?
Because it falls underneath that threshold. It's 0% capital gains rate. So what I'm getting at is if I decide to place my money inside the stock market and I pull my money and my adjusted gross income is $80,000 or less, any gains I've experienced in the stock market, I'm not going to pay capital gains tax on it if I held that stock for longer than 365 days. Now, a capital gain rate of 15% applies if your taxable income is $80,000 or more, but less than $441,450 for single individuals, $496,600 for married individuals and qualifying widowers, $469,50 for head of household, and $248,300 for married filing separate. So the IRS has given us different thresholds to let us know how much money that you make over $80,000 that's going to be subject to the 15% long-term capital gains rate. So as if we have money that we pulled out of the stock market and our adjusted gross income is over that $80,000 threshold, now we're going to be looking towards the 15% tax rate. But we could creep into the 20% tax rate if our adjusted gross income starts to grow. If our adjusted gross income gets to a place where we are at more than $441,450 as a single individual, or our adjusted gross income married is over $469,000, Now our capital gains are at the 20% tax rate. And see, part of the reason why the government is doing this is because the government wants to incentivize young taxpayers to get into investing early. And typically when you're a young taxpayer, you're not making a whole lot of money yet. Maybe you just got into the job force. Maybe you're just working in your first job. Maybe you're only earning a salary of $60,000 to $75,000, which is fine. Which means that if your adjusted gross income falls less than $80,000 with your stock that you pulled out of the market, you're not going to be paying taxes if you fall beneath that $80,000 adjusted gross income threshold. But then as you start to grow and you start to take on more pay raises and your income increases, now you're going to start to peak into this 15% tax range because your adjusted gross income is increasing. If you start to make more and more income in your job force, this is when you'll start to experience high capital gains. The 20% tax rate is reserved for individuals that have earned income in excess of $440,000. So typically you're making really good, considerable income. Now, a lot of my stock investors are getting into the market, but they're also exiting the market early. And that is causing a lot of pain.
You're goddamn right.
Because the tax rates are completely different when you decide to sell your stocks in less than 365 days. Anytime you decide to sell your stocks in less than 365 days, the IRS deems this as short-term capital gains. And short-term capital gains are completely different than long-term capital gains because they have less favorable tax rates, and it's gonna require us to do some calculations. So what we're gonna do is we're gonna dive into what the federal tax rates are for short-term capital gains. As you guys can see here, I have the 7 tax brackets broken down. There are 7 different tax brackets that the Congress has created, and these change every single year. Maybe the percentages might go up or down, or maybe the thresholds might go up or down, but it's typically due to inflation and it's voted on by Congress. Now you'll see here that it starts off with the 10% bracket and it finishes with the 37% bracket. However, there's different rates and different percentages based on where you fall. If you're a single filer, a married filer, or a head of household filer, you may have a different rate based on the amount of adjusted gross income you have. So if you notice here, what it states is that any income from $9,951 to $4,525 is then 12%, and then it falls so on and so forth. So what this is stating is that in order for you to actually be taxed in some of these higher brackets, such as the 35 and the 37% tax bracket, you are going to need to fill up the 10, 12, 22, 24, 32, 35, and then get to the 37% tax bracket before you're actually ever taxed at the 37% tax bracket. So let's go over some examples on how we can calculate short-term gain and long-term gain. Here I have John, who bought airplane stock for 100 shares at $10 a share. Now, after holding the stock for 366 days, long term, John decided to sell all of his stock. At the time of the sale, the stock price was $20 a share. Assuming John has no other taxable income or state income and no deductions, what would be John's capital gains tax? Okay, so let's break this down. He purchased airplane stock for 100 shares at $10 a share, so that's $1,000, right? But then he sold the shares after 366 days, so he had long-term capital gains. The share price increased, it doubled. So he's gonna experience taxes on the gain, not his original amount that he put in. He's gonna experience taxes on the gain that he's receiving. So if he's receiving a gain of $1,000, that's gonna be taxable income to John. But if John has no other income and he's only receiving $1,000, then John falls into the 0% tax rate for long-term capital gains. And he'll pay 0 taxes when he decides to pull out his stocks a year from now. Now, on the contrary, we have example number 2 with Lisa. Lisa's a single taxpayer. She bought X, Y, and Z stock for 500 shares at $150 a share. After 8 months, Lisa sells those 500 shares at $400 a share. So she experienced some gains like John. What is Lisa's taxable income and capital gains tax, assuming she has no other income and no other deductions? So let's break this down. Lisa's single, so we know that she is gonna be a single filer. She bought X, Y, and Z stock for 500 shares at $150 a share. Now, she sold the shares after 8 months at a gain. Now the shares are being sold for $400 a share, right? She's experiencing $250 gain per stock. So if we do $250 times her 500 shares, she's gonna have about $125,000 in gain. And that $125,000 in gain is considered a short-term gain that is taxable income to Lisa. Now, let's break down the math using those federal tax brackets that we just learned for short-term capital gain to factor what Lisa's taxes are gonna be. So the first thing that we wanna do is we wanna use the 10% bracket. So $0 up to $9,950 is gonna be subject to 10%. So that's gonna be $995, which is what we already written down right here. Now, the 12% bracket is from $9,951 to $40,525. So the amount of money that's already being taxed at the 12% bracket is $3,668.88. We've already written that down here. Now we know what she's been taxed at the 10% bracket and the 12% bracket. Lisa made $125,000. So we know she's gonna end up eventually falling into the 24% bracket, but how is she getting there, right? So let's see how much is taxed at the 22% bracket. $40,526 up to $86,375 is taxed at the 22% bracket. So that ends up resulting in $10,086.78 that's being taxed at the 22% bracket. Now, the leftover amount that Lisa had is now being subject in the 24% bracket. But when we look at the 24% bracket, this bracket goes up to $164,925. So if we subtract the amount that Lisa had taxable income left over by 24% in this bracket, that comes out to $18,851.76. Whew. So Lisa ends up having $125,000 that she pulls out of the stock market in 8 months, and she's subject to short-term capital gains. The total amount of taxes she's gonna pay federally before any deductions is gonna be $33,602. Woo, that kind of sounds like a lot of money. And it is a lot of money when you start to think about it, because one of the things that Lisa can do is she can leverage a little bit of tax strategy to avoid some of these taxes associated with her gains. Let's talk about what strategies she can do to avoid some of the taxes associated with these gains. Now, a lot of my clients have sold a lot of their stocks, bonds, Bitcoin in a quick amount of time, less than 365 days, because they needed access to those funds. But one of the things that you can look to do to avoid the taxes associated with those funds is having some tax loss harvesting. Tax loss harvesting is a strategy used by savvy investors who are looking to get access to some of their gains but not pay taxes on the gains. So what they will strategically do is they will strategically sell some of their stocks at a loss towards the end of the year, and then they'll acquire those stocks or another stock in the following year, making up for that loss. But the loss that they have assumed is going to be able to offset the gains that they've already taken from other stock sales. So this is just a method in which you can avoid taxes associated from the gains. Another way that we can avoid taxes associated with the gains from our stock sales is by investing in a Roth self-directed solo 401k that grows tax advantage. Now, we are going to pay taxes on the money that we put in to the Roth IRA. Any money that we contribute, we're paying taxes based on contributions. But the beautiful part about leveraging the Roth self-directed solo 401k or a Roth IRA is that the money is growing tax advantage. When you pull that money later on out in life, you're not gonna pay taxes based on the profits that you receive. So it's a long-term strategy to grow wealth strategically. Not to mention, if you have a self-directed solo Roth 401k, rather than contributing only $6,000 to the Roth IRA, you can contribute up to the $19,500 that the solo 401k allows, and it's still gonna be able to grow tax advantage. And last but not least would be leveraging real estate losses as a real estate professional. This is the biggest thing that I teach as a tax strategist, is teaching other business owners and investors how they can become real estate professionals. Once you become a real estate professional, you're able to leverage active and passive losses to offset all versions of income. And when you're at a place where your losses become active losses, you can utilize these active losses to offset income from the stock market, offset income from your W-2 job, and offset other versions of income if you qualify to be a real estate professional. Now, if you have any questions around these topics today, or if you'd like to learn more, I would love for you to like, comment, subscribe so I can continue to make videos like this for you. And I look forward to seeing you on the next one.